Two opposing economic forces are violently colliding right now to rip the global economy apart. On one side, we have an unparalleled exogenous supply-side shock emanating from the Middle East. On the other side, there is a severe, unexpected demand-side contraction within the domestic United States labor market. Welcome to Coffee Break Capital. Financial markets move fast, but we move faster. Sit down, take a sip, and let's get you caught up on the numbers that matter today. Let's start with the bearish news, because the broader macroeconomic picture is showing profound fundamental economic decay. The most economically devastating consequence has been Iran's effective physical and psychological blockade of the Strait of Hormuz. The Strait of Hormuz facilitates the transit of roughly 20 million barrels of crude oil per day, representing approximately 20% of global daily consumption. Furthermore, it handles a significant portion of the world's liquefied natural gas and dry bulk agricultural shipments. As of early March, at least 150 to 200 compliant tankers and LNG carriers are stranded at anchor in the open Gulf waters. Steamship Mutual canceled insurance for the Persian and Arabian Gulf waters, forcing major global carriers to entirely suspend transits through the region. Vessels are executing massive U-turns and rerouting around the Cape of Good Hope. This logistical diversion adds 10 to 14 days to standard journey times and skyrockets freight rates. The velocity and magnitude of the energy and logistics price shocks act as a massive, immediate, and regressive tax on consumer discretionary spending and corporate operating margins. Aviation fuel prices surged 58% in a single week to $3.95 per gallon. Airlines like United, American, and Southwest have seen equities plummet between 5% and 9% in recent trading sessions. Executives openly warn that fuel spikes will meaningfully erode first quarter bottom lines. The overarching impact of the US-Iran conflict is highly bearish for the broader equity market. If you find this breakdown helpful for navigating these chaotic markets, take a second to subscribe to the channel. We cut through the noise so you can protect your portfolio. Just as global supply chains buckle under the weight of geopolitical conflict, the domestic foundation of the United States economy has revealed profound and unexpected weaknesses. On Friday, March 6, 2026, the Bureau of Labor Statistics delivered a severe shock to financial markets. The U.S. economy unexpectedly shed 92,000 non-farm payroll jobs in February. The headline unemployment rate ticked upward to 4.4% from 4.3%. This contraction represents a massive divergence from market expectations. A consensus of economists had forecasted a positive gain of approximately 55,000 to 60,000 jobs. The headline job loss does not fully capture the extent of the deterioration. The BLS also issued substantial downward revisions, cutting a combined 69,000 jobs from December 2025 and January 2026. The losses were dangerously broad-based. The manufacturing sector cut 12,000 jobs, marking its 14th month of job losses over a 15-month period. Restaurants and bars shed nearly 30,000 jobs, and administrative support services cut 19,000. If the traditionally robust healthcare sector is removed from the equation, the U.S. economy has shed roughly 202,000 jobs since January 2025. This collision of the Middle East supply shock and the domestic labor market contraction has trapped the Federal Reserve in a textbook macroeconomic nightmare. The Fed had maintained the benchmark federal funds rate at a restrictive 3.5% to 3.75% to fight inflation. Historically, losing 92,000 jobs would guarantee an immediate rate cut to stimulate corporate borrowing. However, the Iran war has radically altered the inflation trajectory. The closure of the Strait of Hormuz and the subsequent spikes in crude oil, gasoline, and shipping costs act as massive inflationary inputs. If Fed Chairman Jerome Powell and the FOMC choose to cut interest rates to rescue the labor market, they risk flooding the economy with liquidity, exactly as supply chains constrain, pouring gasoline on the geopolitical inflationary fire. Let's pivot to the bullish interpretation, where specific industries are acting as a powerful catalyst for a prolonged bullish supercycle. The United States energy industry is rapidly emerging as the primary beneficiary of the Middle East disruption. With the Strait of Hormuz bottlenecking global supply, North American crude shipments are shifting toward the Asia-Pacific to compensate. Energy producers are positioned to capture windfall cash flows that will likely be returned to shareholders. Furthermore, the suspension of Qatari LNG exports leaves U.S. producers with immense pricing power and increased dominance over the global LNG market. Simultaneously, the defense sector is undergoing a structural re-rating by institutional capital. The market is increasingly recognizing that modern defense contracting resembles a subscription business model. Because up to 70% of a major weapon system's total lifecycle cost stems from operating, software updates, and depot maintenance, the deployment of assets guarantees recurring revenue long after the immediate hostilities conclude. The agricultural fertilizer complex is also benefiting from pure supply-demand inelasticity. The Middle East accounts for 45% of global sulfur exports and 35% of seaborne urea trade. With Iranian ammonia production completely offline and vessels unable to load Qatari and Saudi Arabian urea, the global nitrogen fertilizer complex is experiencing a historic supply shock. Farmers must procure nitrogen regardless of price, granting Western producers absolute pricing power. North American producers are experiencing surging equity prices as the market prices in windfall margins. Looking ahead, the upcoming economic calendar will serve as the immediate catalyst for intra-week price action. The focal point rests heavily on global inflation metrics and the psychological state of the consumer. The most critical and market-moving release of the week is the United States CPI report, scheduled for Wednesday, March 11th. Market participants will aggressively dissect the core CPI metric, which strips out the volatile food and energy components currently distorted by the war. The forecast for core CPI month over month is 0.2%. Any upside surprise will devastate equity markets by eliminating the possibility of near-term rate cuts. Also, watch initial jobless claims on March 12th, forecasted at 221,000. The market requires real-time confirmation of the labor market's trajectory to see if the February contraction was the start of a deep structural firing cycle. Here is your safe takeaway conclusion. The financial architecture of the global economy is currently under extreme duress. Capital rotation is skewed toward defensive subsectors, including domestic North American energy producers, LNG exporters, defense contractors, and insulated agricultural fertilizer producers. Conversely, broad equity indices, consumer discretionary sectors, and transportation logistics face substantial downward pressure. Consider reviewing your exposure to highly cyclical, consumer-facing industries until the inflation and interest rate picture clears up. This information was compiled from various sources across the internet and is not intended as financial advice.